Good evening. Please come to the next paragraph number 22. Subsequent measurement. How will the accounting for equity settled share based payment plan will be done? So first we'll discuss about equity settled share based payment. So what is the procedure you have learned so far? There is a grant date on which the two parties agree to the terms and condition. There is a vesting date, and the expenditure will be recognized between the grant date and vesting date. We have to estimate the number of options that are likely to vest, right? And every reporting date, with the estimates have to be revised. For example, if the estimate is based on number of employees who will complete 3 years of service, then every year we have to see how many employees will be eligible, calculate the estimated number of employees, and then you have to calculate the total expense based on latest estimate. Calculate total expense based on latest estimate, and then accordingly you apportion the total expense. On the vesting date, the entity shall revise the estimate equal to the number of equity instruments that have ultimately vested. Actually, we have solved already few questions of this type. One more practice. Question number 20. An entity issued 100 shares each to its 2000 employees, subject to service condition of next 3 years. Grant date fair value of the share is 200 rupees each. In case of equity settled share based payment transaction, fair value on the grant date is not changed unless there is a modification in the terms and conditions of the contract. 200 rupees represent the expenditure that we have to recognize. It represents the value of the service the employee is rendering. There is an expectation that employee will remain in service at the rate of 95% at the end of first year. However, the expectation got revised at the end of year 2 to 92% and again got revised to 88% at the end of third year. Calculate the expense to be recognized in each year. So like what it was mentioned in that paragraph, every year we have to calculate the total estimated expense. Every year we have to calculate the total estimated expense, right? And if the estimates change, we will take the latest estimate for the purpose of calculation, and based on that the expense would be recognized. So write down step 1, calculation of expense to be recognized. This question is similar to earlier problem, nothing new. Right hand side 3 columns, year 1, year 2, year 3. Is the vesting period given? That is service condition 3 year. Is it performance based or service based? So it is fixed 3 year. 3, 3, 3. And then fair value per share on the grant date. Fair value per share on the grant date that is also given 200. Number of shares expected to vest under the scheme. Number of shares expected to vest under the scheme. Now this calculation would be done by the student. How many employees are there? 2000. In the first year, what are our expectations? That 95% employees will remain in the service into 95%. And each employee is given 100 options, 100 shares. So the number of shares expected to vest under the scheme is 1,90,000. Now can you tell me second year? 2000 into 92% into 100 is 1,84,000. Last year you write directly 2000 into 100 into 88%, 1,76,000. Each unit has a fair value of 200 rupees. And these are the number of share you are expected to waste. So I will calculate the total expenses, total value of services, B into C, 3 crore 80 lakh, 3 crore 68 lakh, and 3 crore 52 lakh. Then write down point E, cumulative expense to be recognized. Cumulative expense to be recognized 1 by 3 of this number, 1 crore 26 lakh 66,667. And subsequent measurement, again revise the estimate, take the revised calculation, 2 by 3. 2 by 3 of this number, 3 crore 68 lakh. 2 by 3 of 3 crore 68 lakh. 2 crore 45 lakh 33,333. Total 3 crore 52 lakh. 3 crore 52 lakh. Then write down expense recognized up to last year. Up to last year write 0. 1 crore 26 lakh 66,667. 1 crore 26 lakh 66,667 and 2 crore 45 lakh 33,333. One more line right. Expense to be recognized in current year. Expense to be recognized in current year. E minus F. E minus F 1266667 118666667 and 1066667. Is it right? Do we need to pass journal entry for this question? Do we need to pass journal entry? No. Only expenditure that we have to calculate. Only the expenditure. Is it right? Come to the next question. The following particulars in respect of stock option granted by a company are available. No, this is 22. 22. Come to 22. Following particular in respect of stock option granted by a company are available. Grant date 1st April 2006. Number of employees covered 500. Options granted per employee 100. Fair value of the option per share on the grant date is 25. So basic details are given to you. The vesting period shall be determined as below. If the company earns rupees 120 crore or above after taxes in 2006-7, the option will vest on 31st March 2007. So this is a service based or performance based. Vesting condition is service based or performance based? Performance based. In this case, you have to estimate the vesting period. So vesting period could be 1 year if you achieve the earning target of 120 crore in the first year itself. If condition A is not satisfied, but the company earns 250 crore or above after taxes in aggregate in 6-7 and 7-8, the option will vest on 31st March 2008. If condition A and B are not satisfied, but the company earns rupees 400 crore or above after taxes, in aggregate in 2006-7, 7-8 and 8-9, the options will vest on 31st March 2009. So The vesting period can be 1 year. If you are not able to achieve 120 crore, then it can be 2 year if you earn 250 crore in aggregate. If you can't earn 250 crore, then the vesting period will be 3 year, 400 crore. And if you can't earn in 3 year also, then it will lapse. Now what is the position on 31st March 2007? Company earned 115 crore after taxes in 2006-7. Means vesting period cannot be 1 year. The target was how much? 120 crore. You have earned only 115 crore. So vesting period cannot be 1 year. The company expects to earn rupees 140 crore in 7-8. So after taxes, so expected vesting date will become 31st March 2008 because now the total goes above 250 crore. So that means my vesting period at the end of year 1 will be 2 years. Management is expecting that by 31st March 2008 will be able to achieve the target. Number of employees expected to be entitled to the option is 474. This calculation they have done good. Then next year, this is my second year, the company earned 130 crore after taxes in 2007-8. Last year, how much they had earned? 115 plus 130, 245. But the target is 250. So you miss the target. Your vesting period will have to be revised now. The company expects to earn 160 crore in 2008-9 after taxes. So if you add plus 160, does it exceed 400 crore? Yes. So that means now my expected vesting period would be 31st March 2009, 3 years. Number of employees expected to be entitled to option is 465. So this is second year. Now when we go to third year, company earned 165 crore after taxes in 2008-9. Number of employees on whom the options actually vested is 450. Compute expenses to be recognized in each year. So this problem is based on performance condition, and it is performance is a non-market condition. It is related to non-market condition. It is related to profit after tax. Okay. So write down the step 1, calculation of expenses to be recognized. Calculation of expenses to be recognized. Serial number, particulars, 3 columns on the right side. You can write year 1, year 2, year 3 if you want. Okay. First write down expected vesting period. Now in this problem, this is important. Should we take 1 year or 2 years or 3 years? Should we take 1 year? No, but we cannot take 1 year because your condition could not be fulfilled in 1 year. You expect that it will be fulfilled in the next year, so take 2 year. But when I go to second year, it is not fulfilled in 2 year. We'll add 1 more year, 3 year, and then 3 years. Then now write down fair value of the option is 25, 25, 25. Number of share expected to vest under the scheme. Now you have to do a small calculation. How many employees are expected to be entitled to the option? 474 into 100. 47,400. 465 into 100. 46,500. 450 into 100. 45,000. Point number D, write down total expenses B into C. Total expenses B into C. Point B represent fair value of the option, means per share value of service. Value of service per unit into number of shares. 11,85,000, 11,62,500 and 11,25,000. Try one more. Point E, expenses, cumulative expenses to be recognized. Cumulative expenses to be recognized 592,500. Take 1 by 2 because my original expectation was 2 year. Take 2 by 3. Take 2 by 3, 11,62,500. Take full, 11,25,000. 25,000. Is it right? Dear student, write point F. Expenses recognized up to last year 0. This number transfer to next column 592 500. This number transfer to next column 7,75,000, and therefore expense to be recognized in current year. Expense to be recognized in current year 592 500, 1,82 500. Last year 3,50,000. The question was only find out the expense to be recognized in each year. Have you done? This is the question based on non-market related performance condition. Question number 23. The following particulars in respect of stock option granted by a company are available. Grant date 1st April 2006. Number of employees covered 50. Number of options granted per employee 1000. Fair value of the option per share on the grant date 9. Up to this is simple. Now this time you see what are the conditions attached to the grant. The option will vest to employee serving continuously for 3 years from vesting date. So he has to serve 3 years. 3 years is a service condition. So there is a fixed service condition here. Write in bracket fixed service condition, provided that the share price is rupees 70 or above at the end of 2008-9. Fixed service condition plus market condition. Fixed service condition plus market condition, because the second condition is that share prices should be 70 rupees or more. If the condition is vesting condition is market condition, then the expenses will be recognized even if the shares do not vest. Even if the shares do not vest, the expenses will be recognized, because this fair value of the share takes into account the market price in future period. It takes into account the probability and the volatility of the share prices reaching 70 or above. The estimate of the number of employees satisfying this condition of continuous employment are 48 on 31st March 7, 47 on 31st March 8. Number of employees actually satisfying the condition of continuous employment was rupees 45. Okay, so 45 employees are eligible. So we'll do the calculation of expense for 45 employees in the last year. Oh, the share price at the end of 2008-9 was rupees 68. So will you issue the shares? No. But will you recognize the expense? You will continue to recognize the expense up to 3 years, because the vesting condition is market condition. Market condition takes into account the probability of share prices of future period also. So compute the expense to be recognized in each year and show important accounts in the books of the company accounts or journal entry. Past journal entries. In your notebook, it is journal entry. So write down first one note. Write a note. Share price movement is a market based vesting condition. Share price movement is a market based vesting condition. Hence its expectations are being taken into consideration. Its expectations are being taken into consideration in calculating the fair value of the option. So in this problem, I am not going to reverse the expenditure already recognized in the first and second year, okay? Because the condition is a market condition and it is being taken into consideration in calculating the fair value of the option. Hence, the required market, even if the required market condition does not meet, even if the required market condition does not meet, even if required market conditions does not meet, there is no requirement to reverse the expense previously booked. There is no requirement to reverse the expense previously booked. Underline last line. Because in this question, all the options would lapse, but still the expenditure in the third year would be recognized because the calculation of fair value takes into account the possibility of various possible market prices. So now you draw the same table. Step 1, write down calculation of expense to be recognized. Calculation of expense to be recognized. Year, you can write year 1, 2, 3. First write number of years. Vesting period. So vesting period in this example is fixed period. 3 years of service. So employee has to render 3 years of service and plus market condition. So this is called fixed period problem. Here we don't have to estimate the vesting period. Point B, write down fair value of the option per share 999. Fair value takes into account all possible future prices. Then point C, write down number of share expected to vest under the scheme. 48,000, then 47,000 and 45,000. Have you done up to this? Number of share expected to vest under the scheme. Then dear student, write total expenses. You will multiply 9 into 48,000, 4,32,000, 4,23,000 and 4,05,000. Then write cumulative expense to be recognized. Cumulative expense to be recognized 1 by 3 of 4,32,000, 1,44,000, 2 by 3 of 4,23,000, 2,82,000 and last column 4,05,000. Expense recognized up to last year. Expense recognized up to last year. First write down here 0. Then write down 1,44,000. Then write down 2,82,000. Now write down expense to be recognized in the current year. Expense to be recognized in the current year. Expense to be recognized in the current year. What will you write? First column 1,44,000, 1,38,000 and 1,23,000. You will write journal entries. They have asked you pass journal entries. Okay. Or you want to prepare account. Journal entries, write down. Student will write journal entries. I have prepared the account. Journal entries, write down. Date, particulars, debit, credit. First entry will be on 31st March 2007. 31st March 2007. employee benefit expense account debit to share-based payment reserve account 1,44,000, right? Immediately right below P&L account debit 1,44,000 to employee benefit expense account 1,44,000 to employee benefit expense account 1,44,000. Next line, 31st March 2008, employee benefit expense account debit 1,38,000 to share-based payment reserve account 1,38,000. Immediately write down P&L account debit 1,38,000 to employee benefit expense account 1,38,000. One line blank, third year, 31st March 2009. You will write employee benefit expense account debit 1,23,000 to share-based payment reserve account 1,23,000. And one more entry, P&L account debit 1,23,000. We will recognize the expense. We will not reverse the expense. It is market condition. P&L account debit to share-based payment reserve 1,23,000. One more entry will write. All the options will lapse. So the balance lying in share-based payment reserve account will be transferred to general reserve. So you will write one more entry on the same date, 31st March 2009. Share-based payment reserve account debit 4,05,000 to reserve account 4,05,000 to reserve account 4,05,000. Okay. Question number next 24. Choice Limited grants 100 stocks to each of its 1,000 employees on 1/4/2005 for ₹20, depending upon the employees at the time of vesting of options. Now here the period is not fixed. The market price of the share is ₹50. Underline, market price is 50 and what is the exercise price? 20. Exercise price is 20. If the problem does not give you fair value, then you will take the difference between fair value, market price and exercise price, intrinsic value as fair value. These options will vest at the end of year 1 if the earning of the choice limited increases 16%. So it is a performance condition, non-market performance condition, because the option will vest if the earnings increase by 16%, or it will vest at the end of year 2 if the average earning of the 2 years increase by 13%. Or lastly, it will vest at the end of 3rd year if the average earning of 3 years will increase by 10%. So this is how the options will vest. So the maximum allowed period is 3 years. Maximum period allowed is how many years? 3 years. 5,000 unvested options lapsed on 31st March 2006. That is first year. 4,000 unvested options lapsed on 31st March 7. And finally 3,500 unvested options lapsed on 31st March 2008. So this will help you to calculate the expected number of options to be vested. Following is the earning of choice limited. They should have written increase in earning anyway. First year 14%, but my target was 16. Can the vesting period be 1 year? No. Okay, next year the earning increases by 10%. So if I take the average of 14 plus 10 divided by 2, 12%. But the condition was average earning of the 2 years should increase by 13%. Can vesting period be 2 year? No. And then 7, 14 plus 10 plus 7 divided by 3. Is it more than 10%? Yes, 10 point some percentage. So now the options will vest at the end of 3 years. 850 employees exercise their vested options within a year. So 1 year time is allowed to the employees to take a decision whether they want to buy or not. So 850 employees exercise their options. 850 into 100. So 85,000 shares will have to be issued and the remaining shares will lapse. Remaining options will lapse. And the remaining options were unexercised at the end of the contractual life. Past journal entries. So first you write down note number 1. I will dictate. In the given question, fair value of the option is not given. Fair value of the option is not given. Therefore, option will be measured at intrinsic value. Therefore, options will be measured at intrinsic value. Next line, intrinsic value is equal to market price on grant date minus exercise price. Market price on grant date minus exercise price. Next line equal to 50 minus 20 equal to 30. 50 minus 20 equal to 30. Okay. So write point number 2. The standard requires that the intrinsic value should be remeasured. The standard requires that the intrinsic value should be remeasured on each reporting period and settlement date. On each reporting period and settlement date. In the absence of information about market price of share, in the absence of information about market price of share on various reporting dates, in the absence of information about market price of share on various reporting date, it is assumed that intrinsic value will remain same. It is assumed that intrinsic value will remain the same. Then third point write down. In the absence of expected vesting period, given in the problem, we will assume expected vesting period equal to expected vesting period equal to number of years complete plus 1 year. Number of years completed plus 1 year. Number of years completed plus 1 year. Now what is the meaning of this last note? Now we are suppose here 31st March 2006. 14%, I know that vesting period is not 1 year. Then vesting period can be 2 year also or 3 year also. Expected vesting period can be 2 or 3 also. Previous problem that mentioned, management thinks next year I will achieve the target of profit. But this time then nothing like that. So what will you assume? 4. Not 3 plus 1 dear. If 1 year is over, 1 plus 1, 2 year. Then after 2 years are over, 2 plus 1. We'll assume 3 year will be the total vesting period. Is it right? But in the third year, the conditions have been fulfilled. So 3 years only. So 3 years only. And the maximum period allowed is 3 only. If you are not able to achieve in 3 years, all the options would lapse. And since this is a non-market condition, the expenses recognized earlier will be reversed also. If the conditions are not fulfilled, then in third year expenses recognized earlier would be reversed because it is a non-market condition. Okay. So now first you do one small working. Expense to be recognized. Right hand side 3 columns. 31st March 2006. 31st March 2007. 31st March 2008. First write down expected vesting period. Expected vesting period. In first year, when I come to first year, I found that I could not achieve the desired rate of return target. So I will assume we will achieve in the next year. Okay, just like a student assume, if not in this exam, next exam I will assume. I don't assume, oh, I will take 5 years to clear. I always am optimistic. Okay, yes, so solve. Now I have given you the explanation. Your task is to solve. 2. When I go to second year, I found that, oh, I have failed the target this year also. I will achieve next year. 3. And in third year, we have achieved only. So the matter closes in 3 years. Now write down intrinsic value 30, 30, 30. Point C. Number of shares expected to vest under the scheme. Now this calculation is simple. How many employees are there? 1000. Take on your calculator 1000 and each employee is given 100 stocks. So 1000 into 100 means 1 lakh options were given. First year, how many options lapsed? First year, how many options lapsed? 5000. So first year, my expectations would be that only 95,000 options would be issued. Okay. But when I go to second year, 4,000 more options lapsed. So now I expect 91,000 will be issued. When I go to third year, 3,500 more options lapsed. 87,500. So point number D is total expense. B into C. B into C multiply 28,50,000. 27,30,000. 26,25,000. Is it right? Now write down next cumulative expense to be recognized. Cumulative expense to be recognized. First year you take 1 by 2 because I was expecting 2 year would be the vesting period. So take 1 by 2 of 28,50,000. How much is that? 14,25,000. Take 2 by 3 of 27,30,000. 18,20,000. And last year take 26,25,000. Up to this you have done. Now write expense recognized up to last year. 0, 14,20,000, 18,20,000. Last line. Expense to be recognized in the current year. Cumulative minus up to last year. Cumulative expense minus up to last year. First column always same, 14,25,000. Then 3,95,000. Then 8,05,000. Done. Check the answer. Is the answer right? Question is past journal entries. So first 3 year you pass the entry for expenses. Then in the 4th year, the year in which the option will be exercised, we are also going to pass entry for issue of shares. Some options would lapse in this example. So those options which would lapse, we will transfer to reserve. So write down date 31st March 2006. Journal entries, write down journal entries, date 31st March 2006. Employee benefit expense account debit 14,25,000. To share based payment reserve 14,25,000. Is it right? P&L account debit 14,25,000. To employee benefit expense 14,25,000. First year is over, one line blank. Second year, 31st March 2007. What was the amount? 3,95,000. Employee benefit expense account debit 3,95,000. To share based payment reserve account 3,95,000. To share based payment reserve account 3,95,000. To share based payment reserve account 3,95,000. Then write down 31st March 2008. 31st March 2008. Employee benefit expense account debit 8,05,000. To share based payment reserve 8,05,000. And one more entry, right? 31st March 8. P&L account debit 8,05,000. To employee benefit expense account 8,05,000. Up to this, no problem. Now you will tell me the next entry. How many employees exercise their right? 850 into 100 means 85,000 shares will be issued, and the exercise price is 20 rupees. So they are going to pay me 20 rupees also. So bank account debit will be 85,000 into 20. They have also rendered the service to us. The value of those services are 30 rupees per unit. So I will consider that also. Then we will issue the shares. So write down, first understand one by one. He will pay me 20 rupees per share, bank account debit, 85,000 shares into 20. He has rendered services also, which we have accumulated in share based payment reserve. So if shares are to be issued, the share based payment reserve will be transferred to share capital or securities premium account. Share based payment reserve account debit. Check the calculation, 85,000 into 30, 25,50,000. To share capital account, 85,000 shares into rupees 10. 85,000 shares into rupees 10. How much? 8,50,000. And to securities premium account, 85,000 shares into 40 is 34 lakh. Being 85,000 shares issued, But now you tell me how much balance is left in the share-based payment reserve account? 75 rupees. 75,000. How many options were not exercised? We had assumed 87,500 options will be exercised. But only 85,000 could be exercised. So 2,500 options have lapsed. So those lapsed option balance will be transferred to reserve account. Share-based payment reserve equity account debit 75,000 to general reserve 75,000. Okay. General reserve or just write reserve 75,000. Being balance in share-based payment reserve transferred to reserve rupees 75,000. Now we'll go to one more question number 25. Easy problem. On 1st April 2006, a company offered 100 shares to each of its 500 employees at rupees 40 per share. Okay. The employees are given a month to decide. So what is the total vesting period here? 1 month to decide whether or not to accept the offer. The shares issued under the plan shall be subject to a lock-in on transfer for 3 years from the grant date. The market price of the shares of the company on the grant date is rupees 50 per share. Market price is 50. But these shares which will be issued will be subject to a lock-in on transfer for 3 years. So will the fair value of such shares be affected because of lock-in condition? Yes, because this share will not have liquidity. This is a share which you can easily transfer. This share you cannot transfer. So it has a liquidity problem. So therefore this line is important. Due to post-vesting restriction on transfer, the fair value of the shares issued under the plan is estimated at rupees 48 per share. And what is the price the employee will pay? 40 rupees. So employee will pay 40 rupees for a share whose fair value is 48 rupees. So what is that 8 rupees difference equal to? It is the value of the service he has rendered. Okay. On 30th April 2006, 400 employees accepted the offer and paid rupees 40 per share purchased. Nominal value is rupees 10. Record the issue of shares in the books of the company under the aforesaid plan. Market value of the share is 48 rupees and the employee has to pay only 40 rupees. So this 8 rupee difference is the employee benefit expense. It is for the services rendered by the employee. Okay, and that will be treated as employee benefit expense. So have you written the answer? Write down date 30th April 2006. I will first issue shares to employees. He will make me the payment. What is the payment we will receive? How many employees decided to buy the share? Into 100 into 40. 16 lakh is what he will pay me in cash. Because we are giving him a discount compared to the market value, it is for the services that he has rendered to me. So that is called employee benefit expense account debit. 40,000 share into 8 rupees. Which 8 rupees? 48 minus 40. Do not take 50. Do not take 50. because 50 is the market price of the share without transfer restriction. 48 is the market price of the share with transfer restriction. Since these shares are subject to transfer restriction, we'll take the fair value with transfer restriction. How many share will be issued? 40,000. Nominal value 10 rupees, 4 lakh. What about the remaining amount? The remaining amount 38 rupees per unit, 15 lakh 20,000 will be transferred to securities premium account. Being 40,000 shares issued at a premium of rupees 40, at a premium of rupees 38 per share. Only 1 month is involved. Actually, this plan is giving the benefit for the services which he has already rendered. Uh-huh. You want to, there's no need to pass that entry.
So my expense would be different. If I consider that initial 500 cents were given. 500 cents were given to 500.
Options were given to 500 employees.
My expense charge would be different. Right?
Now, this is a different plan. It is called Employee Stock Purchase Plan, ESPP. So, those only who are going to acquire the shares, only with respect to those employees, we recognize the service. Company may have lakhs of employees, but many times all of them don't take that option of buying the shares. So, we will recognize expense only for those employees who are going to buy the shares. Unnecessary, it will, on one hand you will increase the expense, again you will route it to reserve account. So better you pass entry for those employees only who decide to purchase the shares. That is the loss to the company. So it's like a loss to the company. So how much is the loss in this deal? 8 rupees per unit on 40,000 shares. Okay, now you come to para 23 below. Cash settled share based payment. Now, what is a cash settled share based payment? Already we have discussed earlier also. The counterparty will receive cash. Then, sir, how it is cash settled share based payment? The amount of cash that will be paid is linked to the market value of the share. So, the market value of the share goes up, he gets more cash. If the market value of the share comes down, he gets less cash. And sometime he may not get any cash also if the market price is not achieved. Because you have to pay in cash, such plans are recorded as liability. And because it is a liability, it will be fair valued on each subsequent period and till the plan is settled. So even up to the date of settlement, we are going to do this accounting. On that day, what was the amount, market price, how much is the difference, that much cash will have to pay. So let us practice one more question on this cash settled share based payment. A company announced a stock appreciation right. Question number 26. On 1/4/2006, for each of its 525 employees, the scheme gives the employees the right to claim cash payment equivalent to excess on market price of company share on exercise date over the exercise price of rupees 125 per share in respect of 100 shares, subject to condition of continuous employment for 3 years. So in this example, what is the amount of cash paid? Difference between market price and 125 rupees. So when he is entitled to receive cash, if the market price exceeds the exercise price. The stock appreciation right is exercisable after 31st March 2009, but before 30th June 2009. So first he has to complete 3 years of service, which is ending on 31st March 9. Any day after that day, he can go to the company and demand cash, but that is only up to 30th June 9. The fair value of the stock appreciation right is 21 in the first year, 23 second year, 24 third year. In 2006-7, the company estimates that 2% of the employees shall leave the company annually. This was revised to 3% in 2007-8. Actually, 15 employees left the company in 6-7, 10 left in 7-8, and 8 left in 8-9. The stock appreciation right therefore actually vested to 492 employees. Then on 30th June, what is the significance of 30th June 9? This is the date of exercise. Stock appreciation right was to be exercised. Intrinsic value is 25. Intrinsic value means the difference between market price and exercise price. So finally, what is the amount the employee will get per unit? 25 rupees. Show the provision for stock appreciation right account by the fair value method. But first, what you need to do, you need to calculate the expense to be recognized in each year. That will dependent on one, the expected number of employees, and second, it is also going to change because the fair value is also changing, right? So right on step number 1, a very important question. In a lengthy question, they add such problem as a part of a very bigger problem. So that itself is one exercise you will have to perform. Expense to be recognized, right hand side, 3 columns. 2006-7, 7-8, 8-9. Point number A, fair value. Fair value 21, 23, 24. Is it given? Now I am going to ask you a question. How many options do you think will get exercised? When you are doing accounting of this year, calculate the expected number of options that will waste. Calculate the expected number of options that will waste. $495. 494. So let me explain to again. Point B, right, number of SAR expected to waste. How many employees were there in the beginning? 525. Same problem we have solved yesterday also. In the first year, how many employees have already left? 15. 15 have already left. So if those who have already left, we know the exact figure of first year. First year, we know this is the number of employees. So the 2% retirement or whatever they will leave is applicable for future period. In some books, what they have done, they have taken 525 into 98% 3 times. But then my argument is that why do you need to estimate for the current year? Because this number is known to us. Into 98% into 98%. Next 2 year 2% would retire into 100. So this comes to 48,980. You can round off if you want to 48 or 49,000 also, no problem. It's only an estimation. Don't take so much tension. And then next year we have actual data of 2 year, an estimation required for 1 year. So 520 minus 15 minus 10 and into 97% into 100. Is it 48,500? And then 492 into 100, 49,200. This is given. This figure is already given in the question 492. Point number C, write down total expense. Total expense. A into B. A into B, 10 lakh, 28,000, 580, 11 lakh, 15,000, 500, 11 lakh, 80,800. Do you agree? Now write vesting period 3 years, 3 years, 3 years. This is a fixed vesting period problem. Only after 3 years he will get the rights to get cash. And point E, write down cumulative value of SAR to be recognized. Cumulative value of SAR to be recognized 1 by 3 of 1028 580. Is it 342 860? Then 2 by 3 of 11 lakh 15,500. Is it 743 667? And then 11 lakh 80,800. Point F, write down value of SAR recognized as expense in previous year. 0, 342 860, 743 667. Last line, right? Value of SAR to be recognized in current year. E minus F. 342 860. Correct? 4 lakh 807 and 437 133. Now write down one more calculation we will write. This is for up to first 3 year, but the option will be exercised after third year. So what will be the expenditure to be recognized in the fourth year? When the options were to be exercised, the intrinsic value was 25 rupees per share. We have already made provision up to 24 rupees per share. So I have to pay 1 rupee more. So either you can write like this, or you can just write down how many options? 49,200 into 25 minus 24. So what would you prefer? Second option. Choice is yours. Expense to be recognized in year 2009-10. You can write like this, the way it is appearing on the screen, detailed version, or you can just write a shortcut version. 49,200 into bracket 25 minus 24 rupees 49,200. Now we'll prepare ledger account in this problem. Ledger account, write down. In the books of company, provision for stock appreciation right account, in bracket liability. Only one account they have asked you, the liability account. So first you understand the entry. Entry is employee benefit expense account debit to provision for SAR account. Okay. And we are preparing provision for SAR account. So first go to credit side. Write down 31st March 2007. By employee benefit expense, first year figure take from the table 342 860. Is it there? And debit side to balance carried down. To balance carried down 342 860. Credit side next year 1st April 2007. By balance brought down 342,860. And by employee benefit expense, 4,0807. Two balance carried down 31st March 2008. Correct? Just normal accounting. 743,667. Now write down on the credit side next year 1/4/2008 by balance brought down 743,667 by employee benefit expense 437,133 and two balance carried down 11,80,800. Answer is not over. 1/4/2009 by balance brought down 11,80,800 by employee benefit expense 49,200. 30th June 2009. And then debit side, what will you write? To cash and bank. Payment made 12,30,000. This is how your account looks like in your notebook. Just check. Right. One homework, note down as homework. There is an example printed below question number 26. Homework. Solution is there. Just check it later whether it is right or not. Now we'll come to the next part, that is modification, cancellation and settlement. Normally, whatever fair value grant date is there, grant date fair value, we follow that throughout the vesting period. But sometimes the terms and conditions of the plan can change. What are the possible change in terms and conditions? Vesting period may be revised. Exercise price may be revised. Okay. Now, because of the change in the terms and condition of the plan, fair value of the option can increase and the fair value of the option can decrease. If the fair value of the option will decrease, it means the expenses will reduce. The standard says if the fair value of the option decreases, means your expenses will decrease. Ignore. Why? Because fair value on the grant date is the minimum expense we have to recognize. That is what we had initially agreed. So any change in the terms and condition which reduces the fair value of the option will be ignored. But if it increases the fair value of the option, it increases my expenses. My expenses has increased, my cost has increased, so that will be recorded. So for example, it might reduce the exercise price. Now, how does reduction in exercise price affect the fair value of an option? Do you have any idea? See, normally intrinsic value is market price minus exercise price. So first understand intrinsic value. Market price is 100 and exercise price is 50. It means intrinsic value is 50. Suppose market price is 100, intrinsic price is reduced. Sorry, exercise price is reduced. So now your intrinsic value will become 70. So your cost has gone up. Now in this question we have just computed the intrinsic value. The fair value of the option is also calculated in a similar way. So if I apply Black and Scholes model, which model? Black and Scholes. What is the formula? S0 into ND1 into e to the power minus RT minus e into n This is not E into ND1 ND2 into E to the power because present value of exercise price we have to get. So most of you have not understood unless you have read Black and Scholes model. Even if you have not understood, S minus E you have understood, rest all you forget. S means share price, E is exercise price. So if exercise price is reduced in the equation, the fair value of the option will go up because other factors are constant. So if this number goes down, the answer goes up. Okay, and reverse. If this increases, the fair value of the option goes down. Normally, company will not increase the exercise price. Employees will not agree easily. But sometimes the share prices start falling for a company. Then the employee thinks, what is the point in continuing with this option? Because the market price of share has already gone down. I'm not going to get any benefit. So the company will say, okay, don't worry, we will reduce the exercise price. So that is called modification. And sometimes the two parties may agree, okay, forget it, cancel it. Cancel the entire plan only. So that is called cancellation. And sometimes the plan may be cancelled, and in lieu of cancellation, some cash may be paid to the employee. Okay, we'll cancel the plan, you take 20 rupees per unit or 1000 rupees, whatever. That is cancellation and settlement. Now the question is how to account for it. So when you are reading a problem, check that whether there is a modification in the terms and condition of the plan. If yes, then check whether there is a reduction in the fair value or there is an increase in the fair value. If there is a reduction in the fair value, para 25, if there is a reduction in the fair value, then the SBP will be recognized at original agreement value as if there was no modification happened. And the reason they have given in the standard is the amount that you have agreed at the beginning is the minimum expense we have to recognize. I can't go down below this. But if the modification increases the fair value, it means I have an additional cost. So I have to recognize that additional cost, the increased value. So one thing is you have to recognize additional cost. Then next question, how will you recognize it? Now this you will recognize it over the remaining period of share-based payment. So original cost you will continue to recognize as it is. Plus this additional cost will be recognized over the remaining vesting period because this benefit you are going to receive over the remaining vesting period only. This benefit, which is now you have modified, you are going to enjoy the benefit of that service over the remaining period of SPV, and therefore this increased cost will be recognized over the remaining period of SBP. Is it right? So have you understood the reason for why we ignore this and why we provide for it and why we provide it over the remaining period? Because this benefit will now be received only over the remaining vesting period. The requirement is applicable irrespective of any modification of terms, cancellation or early settlement, if any. So first we'll take a small example on modification, then we'll take on cancellation. Little difficult question. Marathon Inc. has issued 150 share options to each of its 1000 employees subject to the service condition of 3 years. First line is easy. 150 option, 1000 employees, 3 year of service condition. Fair value of the option was calculated at INR 129. which means 129 rupees I have to recognize. Okay, this is a minimum we have agreed. Minimum agreed amount. Below are the details and other activities related to SBP plan. In year 1, 35 left. Oh, why can't people stay? Further, 60 are expected to leave. Remove this INR. 60 are expected to leave. So, how many employees are expected to satisfy the 3 year of service condition? 1000 minus 95 now. So, we expect 905 employees will survive for 3 years in the organization. Now, then what happened after year 1? Share options were repriced. Why share options were repriced? Because the market value of the share had fallen, as the fair value had fallen to INR 50. Okay. Now fair value has gone down from 129, it has gone down to 50. So will I give the effect of this decrease? The answer is no. Okay. The answer is no. So therefore, we will continue to account at the same 129. Now there is one more line. After the repricing, they are now worth INR 80. Hence, expense is expected to increase by 30 rupees. After this, there is another repricing. After repricing, they are now worth 80 rupees. So 80 rupees. And they are now worth 80 rupees. Hence, expenses is reflected by increase by 30 rupees. I just need to explain these 2 points again. There is one line which is missing in the note, how to calculate the incremental cost. Okay. So you can just add one sentence in the notes. And since that line is not written, this may be difficult for you to interpret. I'll explain. Incremental fair value per share equal to fair value of modified option minus fair value of original option on the date of modification. Incremental fair value per unit is fair value of the modified option. Fair value of the modified option means with the revised terms and condition, what is the fair value? So in this example, what is the revised fair value? 80 rupees. And what is the fair value of the original option on the date of modification? This is this line. Share options are repriced as the fair value had fallen to INR 50. Original options fair value. Original options fair value on the date of modification has gone down to 50 rupees. Because the fair value will keep changing every year. True or false? Because fair value depends on remaining number of years. Fair value depends on expectation about the market price. Original option with original terms and conditions, the fair value is now 50 rupees as the share prices have gone down. But with modified conditions, the fair value is now 80 rupees. So this 30 rupees will be treated as incremental expense. Remaining are just your basic information. Year 2, 30 employees left. Further 36 expected to leave. Year 3, 38 left. How the modification or repricing will be accounted for? 129 rupees we will account for each year. So that you treat it as one problem. 30 rupees you will treat it as another problem, but that will be recognized as expense only in the second and third year. Additional expense will be recognized only in second and third year. Now your queries are welcome. Because the standard says if on the date of modification or repricing, if the fair value of the modified option is more than the fair value of the original option, and the fair value of the original option on the date of modification is 50 rupees, that difference is your incremental fair value. So that is your incremental cost, and that will be recognized over the remaining vesting period.
Already I am recording at 1.
That 129 is okay.
Any changes that takes place below 120, it's anyways not.
For calculation purpose, you have to compare the two fair values on the same date, and that is the date of modification. So on the date of modification, if there is a difference and the difference is positive, then it is my additional expense.
So it could have been if I had recognized my expenses at 50. I am not recognizing my.
That 129 will continue.
Then why again? Even if what?
129 is original grant date fair value. That is a minimum expense I have to recognize. On the date of modification, the incremental fair value will be the fair value of modified option and fair value of the original option measured on modification date. If that difference is positive, that is my incremental cost, and then that will have to be revised because they have revised the terms and conditions. So if they have revised the terms and condition, there is again an impact of the fair value, and based on revised terms and condition, if the difference is 30 rupees and additional, then it is my additional cost, and that you have to recognize over the remaining 2-year period. So that is the explanation of this reason. And first year there will be no problem, right? Step 1. Additional expense is based on the two fair values on the same date, that is the date of modification, and original fair value will continue. First, write down expense to be recognized in year 1. Under that, write down fair value of the option per share 129. Number of shares expected to vest under the scheme. Number of shares expected to vest under the scheme, 1000 employees, 35 left, 60 expected to leave, multiplied by 150. 135 750. 135 750. Therefore, total expense. Multiply the two and write down the figure. 1,75,11,750. Value of option recognized as expense. Divide by 3. Expense to be recognized. Write down this much. Expense to be recognized 1 by 3 of 1,75,00,000 How much is the answer? 58, 37, 250. Now write down year 2. Step 2, expense to be recognized in year 2. Expense to be recognized in year 2. My original calculation will continue. Point number A, right? Number of share expected to vest. Number of share expected to vest. Now, how many employees are there? 1000. How many left? 35 and 30. 65. How many expected to leave? 36. And into 150. 134,850. Then write down total expense of original option. Total expense of original option. Total expense of original option multiply 134,850 into 129. 173,95,650. And point C, write down expense to be recognized for original option. Expense to be recognized for original option. Two-third of 173,95,650 into 2 by 3 minus previous year. Go to previous year. Previous year is 58, 37, 250. 57, 59, 850. This is for original option that will continue. And then the question says due to repricing, expenses is expected to increase by INR 30 rupees. So now I will calculate incremental expense. Point number D, incremental expense to be recognized due to modification. Incremental expense to be recognized due to modification. 134,850 into 30, that is total, and now you divide it over 2-year period. 2-year period. So that is 20, 22, 750. So total will be how much now? Total will be total expense to be recognized in year 2. Add these two number. One for this original option and one for incremental expense. The total comes to 77,82, 600. Okay, now last year is easy. No complicated calculation. First write down heading expense to be recognized in year 3. Under that A, number of shares expected to vest. 1000 minus, how many employees have left? 35 minus 30 minus 38. What is the final answer? 134? 550. I had some doubt. So this total of people who have left is not coming to 104. Is how much? 35, 30 and 38. 103. So this calculation will be how much? 135? Yes, 150 rupees extra. Now write down total expense of the original option. Total expense of the original option 135,500 into 129 is 1,73,37,600, but this figure will change. How much? 173 56 950. And point C, write down expense to be recognized for original option. Expense to be recognized for original option 173 56 950 minus 58 37 250 minus 57 59 850. Final answer how much? 57 59 850. Sure. And then write point D, incremental expense to be recognized due to modification. Incremental expense to be recognized due to modification. Incremental expense to be recognized due to modification 134,550 into 30 minus previous year 2022 750. How much it comes to? 13,13,750. So my next question is, what is total expense to be recognized? 77, 73, 600. You will add these two numbers. 57, 59, 850, 20, 13, 750. 7773 600. Okay, so now we will take a break.